Now, let us distinguish partnership with other forms of organization. Let us see what are the other forms of organization. Now, this you would have done in your 12th standard also, in the subject Organization of Commerce. So you would have studied different types and forms of organization like sole proprietorship, partnership, company, HUF, co-venture, joint venture, co-owners, clubs, etc. So now let us study the differentiating factor between partnership firm and these other forms of organization. So let's start with the distinguish between partnership and company, and gradually we'll move on to HUF, co-ownership, club, association and joint venture. So this is the distinguishing, these are the distinguishing features between partnership and company. The first is legal status. Now, this is one of the important distinguishing features. Legal status. A partnership firm does not have a separate legal identity of itself. A partnership firm cannot purchase property in its name. A partnership firm cannot hold property or sell property in its name. A partnership firm, a case cannot be instituted against the name of a firm. You can always institute a case against all the partners. A firm can always purchase a property in its name, but that means that the right is vested with all the partners. The partners become the owners. The firm itself does not come up. It does not become an owner. It does not become an entity. There is no separate legal status. There is no separate legal entity of the firm. However, when you go, look at a joint stock company, it has a separate legal entity. It is an artificial person in the eyes of law. It can own property. It can sell property. It can institute cases, and cases can be instituted against it. So when there is a liability against the company is liable. The shareholders are not the liable, because shareholders are different from the company. But in case of partnership, when there is a liability on the partnership, that means the partners are liable. They are no different from the firm, or the firm is no different from the partners. There is no separate legal status of the firm. It is not a person in the eyes of law. So whenever we say firm, that means it refers to all the partners taken together. There is no difference between the firm and the partners. Next is agency. In the partnership, we have mutual agency. We've already discussed this. There's no mutual agency in the firm. This is the distinguishing feature. This is the feature that defines partnership. That is a conclusive evidence of partnership. Next is distribution of profit. Profits must be shared. We all know that there is sharing of profit in the partnership. And here, dividends are declared. Actually, if you see, both are the same things. Sharing of profits or declaring and distribution of dividend. There's only difference of the nomenclature, the difference of the name. Otherwise, both are same. You share the profits or you declare dividend. Ultimately, you are distributing the profit. However, the name or the nomenclature, as we say, is different. Extent of liability. The partners in a partnership firm are personally liable for the debts, for the liabilities of the firm. So the liability in case of partnership is personal. However, shareholders are not liable to the company if there is a liability on the company, if they have paid all the money which they are supposed to pay of the share. So they are liable only up to the face value of the share. And if a shareholder has already paid the face value of the share, then he is no more liable. However, if some amount of face value of shares is still pending to be paid, then he can be liable only for that amount. Now let's say that there's a company which has shares and the face value of the shares is 10 rupees. Now there's this shareholder who has paid 6 rupees on every share. He holds, let's say, 100 shares. So now if the need arises, if there is some liability on the company, it can go to the shareholder and tell him that, boss, 4 rupees per share is pending from your side for each share, and you hold 100 shares. That means you have to pay to the company 400 shares, 400 rupees. So he'll be liable for 400 rupees because 600 rupees he is already paid. In total, he holds the shares of 1000 rupees, 100 shares into 10 rupee per share. So he has to pay the company 1000 rupees only. Out of which 600 he is already paid. 400 he is now required to be paid. But let's say he has already paid 1000 rupees. Now can the company go to this shareholder and tell him, pay money because I need to pay my loans, or I need money for winding up? Can the company go to this shareholder? No, the company cannot go to the shareholder and ask him for more money. So this is the differentiating factor. In the partnership firm, the partner is personally liable. To pay the debts of the firm, he might still sell his personal assets. So he is personally liable. But in case of a company, a shareholder is not liable for more than the face value of the share. Property. In case of partnership, the property of the partnership, whatever assets the partnership has, is a joint estate, is the joint property of all the partners. However, in case of a company, it is the property of the company and not of the shareholders, because company has a separate legal status. Since it has a separate legal status, it can hold, it can own, it can sell property. So whatever the property a company has, it is the company's property, not the shareholder's property. But whatever the property a firm has, it is the property of all the partners. It is a joint property, joint estate of all the partners. Next, transfer of shares. Normally, if you ask me, share cannot be transferred in a partnership firm. Let's say there are 3 partners, A, B and C. A wants to transfer his share to D. Can he do it? In normal circumstances, he cannot do it. However, if all the partners give their consent, if all the partners agree, he may transfer his share. However, in case of a company, there's unrestricted transfer. If you have, let's say 100 shares of Reliance, you can sell them anytime you want. If you have 10 shares of Infosys, you can sell them anytime you want. Nobody can stop you. However, shares of a private company cannot be easily transferred. There are some restrictions on the transfer of shares of a private company, but there is no restriction on the transfer of shares of a public company. So they can be easily transferred. Management. A partnership is managed by all the partners who are the owners themselves. A company is managed by directors who may or may not be the ownership. So there is a segregation of ownership and management. There is separation of ownership and management. So these directors may be the owners, they may not be the owners. All the shareholders together do not manage the company. They elect some directors, some professionals who act as the directors, and they manage the company. Now, it may be so that these directors are, holding shares of the company, so they are the shareholders or owners. It may also be a case that they do not hold even a single share, yet they are the directors and manage the company. But this cannot be the case in partnership. It is the partners who look after the affairs of the firm. Okay. Number of membership. The first feature of partnership is at least 2 persons. So you need minimum 2 persons to form a partnership firm. Maximum as it is prescribed. We know the maximum limit is prescribed in the Indian Companies Act. So as per Companies Act, the maximum limit, which is currently 100. However, central government may set a lower figure. But in case of company, there are two types of companies, private company and public company. To form a company, you need minimum 2 members, and in case of a private company, maximum there can be 100 members. If a company wants to have more than 100 members, then it has to form a public company. It will become a public company. So for a public company, minimum 3 members are required and maximum no limit. There can be infinite number of members. There can be 1 lakh, 10 lakh, 1 crore. There's no limit. There can be infinite number of members in a public company. There's no maximum capping. There's no maximum limit. Duration of existence. The partnership exists till the death of the partner or the insolvency or the retirement of the partners. After that, it gets dissolved. So the partnership is dissolved automatically on death, insolvency or retirement of the partner. Then it is over. However, a company has perpetual succession, it has perpetual existence. Even after the death or insolvency of a shareholder, the company does not get dissolved. Even if a member has sold his share, the company does not get dissolved. It continues to be in existence till the time a resolution is passed to close down the company, which is called as the winding up of the company, or there is a court order which says the company needs to be wound up. So until and unless that order is passed by the court or resolution is passed by the members, the company will have a perpetual existence or a perpetual succession or a perpetual life. Audit. Now, audit of a firm is not a compulsory thing. It's not a compulsory feature. There's no compulsion for audit of a firm because the Indian Partnership Act 1932 does not talk about the audits. It is silent. That means it has not put any compulsion that the accounts, the books of the firm should be audited. However, the Indian Companies Act puts a compulsion, puts a legal compliance on the companies that they have to get their books, get their accounts audited by a chartered accountant. So, audit of company is compulsory, whereas audit of a firm is optional. It is not compulsory.